Before you put a dollar into a market, it's important to understand it. Not just the surface stuff, not just the city is growing or I heard rents are up or down. It's more than that. It's actually understanding it, the data behind it, the trends that drive it, and the risks that don't show up in the pitch deck that someone sent you. Because in commercial real estate, the market you choose to operate in is the single biggest variable in whether a deal works over the long run. You can buy a great building, sure, but you can still struggle if the market around it is working against you. Today, we're gonna walk through how to actually research a market before you commit capital to it, the things to look at, what the numbers are telling you, and all in all, why the best opportunity might be closer to home than what you think. So starting with the population growth, obviously everything kind of flows from this. A market that's growing in population is a market with expanding demand. More people means more workers, more businesses, and ultimately the more need for space. Industrial, retail, multifamily, whatever it is. It's not a guarantee of anything on its own, but it builds the foundation. What you want to see isn't just that a market is growing, but that it's growing consistently for reasons that are likely to continue. Migration trends, climate, cost of living, everything relative to those markets. These are the forces that drive population movement right now. And a lot of the Sun Belt and Mountain West cities, they've been durable for long enough that they're worth taking seriously. Now on the flip side, a market with flat or declining population needs a much higher bar. It can still work. There are stabilized assets in slower markets that can still generate that income, but ultimately the wind is not pushing back and you need that price into your underwriting. Now, population growth alone isn't enough. You also need to look at what that population is doing for work. This is the job diversity piece, and it's one of the most important and underappreciated factors in market analysis. A market that's driven by one or two major employers is fragile. You might not feel it for years, and then one company announces a layoff or a relocation and the domino effect hits everything. Vacancy rates go up, rent growth stalls, values drops. It happens quicker than you think. What you want to see is a diversified employment base. Healthcare, logistics, manufacturing, technology, education, a mix of everything so that you aren't putting all your eggs in one basket. That kind of market tends to be more resilient through economic cycles, the ups and the downs, and resiliency is essential when you're holding an asset for 5, 10, 15 years. When you're researching this, look at what the major employers are, what share of the local workforce they represent, whether employment has been growing across different sectors or if it's concentrated in just one. The Bureau of Labor Statistic data gets you a long way. So does just paying attention to local business news in the markets that you're looking in. So you've got a market with solid population growth and a diversified employment base. Now, it's important to understand what rents are actually doing. These trends tell you whether demand is actually translating into pricing power for the landlords. You want to see rents that have been moving upward over time. Not necessarily dramatically, but consistently. Flat rents in a growing market can be a signal that new supply is keeping pace with demand, which isn't necessarily bad, but it changes the calculus. Declining rents in a market that look good on the surface is a yellow flag worth looking into. For commercial especially, rent trends vary a lot by asset type. Industrial rents have behaved very differently than retail, and the same goes for multifamily. So when you're doing this research, make sure that you look at rent data for your specific asset class that you're targeting, not just headline numbers, because those can vary. CoStar, CBRE, and JLL all publish sub-market level rent data if you have access to those resources. Local brokers are also a great resource here. They work in these deals every day. They work around these markets, and they have, ground level experience that the data doesn't always capture. Closely related to the rent trends is also the vacancy rate. These two numbers kind of tell a story together. Low vacancy and rising rents means demand is outpacing supply. Landlords have the leverage, and that's a favorable environment to own in. Now, high vacancy with falling rents is the opposite signal. What you also want to watch is the direction of the vacancy, not just the level. A market with a 10% vacancy rate that's been on the downhill slope for 2 years is a completely different story than one that is at 8% but climbing consistently. Trajectory matters just as much, if not more, than the current number. And for most commercial asset types, a healthy, stabilized vacancy rate is somewhere in the single digits. You know, like anything, what's normal varies by the asset class and the submarket. Industrial tends to run tighter than retail in most markets, and multifamily varies a lot by the city. So it's important to know the benchmarks for the areas that you're looking in. Now, here's one that a lot of investors undervalue: the new supply pipeline. And this can really bite you if you're not paying attention. Even in a strong market with low vacancy and a good rent growth, a wave of new construction coming along in the next 12, 24 months can really change the picture. If the market is absorbing 50,000 square feet of industrial space per year, and there are 300,000 square feet under construction right now, you've got a potential oversupply situation in the near future. It's not necessarily a deal killer, but it absolutely has to be in your underwriting assumptions. Most commercial brokers and market reports will include a pipeline section, what's under construction, what's been proposed, what is soon to be, and what's recently been delivered. This is important to take a note of. A lot of people look at the vacancy rate and today's rents, and that's about the extent of their analysis. The operators who get ahead of these problems are the ones who also ask what the market is going to look like in 2 years when all the new product hits. So let's talk about landlord-tenant laws, because this one is about risk management and it affects your operating assumptions more than you might think. Different states and areas have very different frameworks around things like lease enforcement, eviction timelines, rent control, and tenant protections. In some markets, you can move through an eviction process in a matter of weeks. In others, it can take the better part of a year, and those legal costs can add up. In certain jurisdictions, there are rent stabilization rules that apply to even some commercial properties, though, it's probably more common on the residential side. The point isn't that you should avoid markets with stronger tenant protections. Some of the best markets in the country have complex environments and regulations. The point is that you need to know what you're walking into before you ultimately own a building there. Legal costs, eviction timelines, lease structure, all of these things have an effect on your underwriting. A deal that looks good in one environment may look entirely different in another. This is one area where talking to an attorney who specializes in real estate is worth every single dollar. Do it before you buy, not after the problem surfaces. And then there's the price to rent ratio. This one is more of a valuation kind of sanity check than anything else, but it's a useful lens. It's essentially what you're paying for the income the asset produces. So in commercial real estate, we usually talk about this through what we call cap rates, the capitalization rate, which is essentially the property's net operating income divided by the purchase price. The underlying idea is the same, but it basically says, are you paying a price that makes sense relative to what the market will bring you back in rent? And in markets where asset prices have run up faster than rents, you end up with compressed cap rates, meaning you're paying more for every dollar of income. Now, that's fine if you believe rents are going to catch up and you can underwrite and you can plan for that growth. It becomes a problem if you're counting on income that isn't quite there yet. So comparing price to rent dynamics across markets is a good way to identify where you're getting more income per dollar invested versus where you're buying more appreciation potential. Neither is inherently wrong, but you should know which one you're doing. Now, all of that covers how to evaluate a market you're looking at from the outside, but I want to look at something a little bit closer that I think gets overlooked, especially by investors who spend a lot of time watching what's happening in other cities. It's important to not overlook your backyard. And that's the market you're already in. Where you live, where you have relationships, where you know people, you know brokers, you know tenants, and you know the regulations. Now, this background knowledge has advantages that don't show up in a data set. You can physically drive the submarkets. You can see which corridors are getting new investment, which neighborhoods are quietly turning, which landlords might be struggling, and where a motivated seller might be. You have context that an out-of-state or out-of-market investor simply just does not have, no matter how good their research or data is. A lot of people assume the best deals are in the next town over or another state. And sometimes they are, but a lot of times that edge of familiarity is a bigger advantage than you might think. So don't be so focused on what's happening in other markets that you end up missing what's right in front of you. Now, market research is not a one-time exercise. It is an ongoing habit. The markets that look great today look different 5 years ago, and they'll look different 5 years from now. The operators and investors who stay informed, who are consistently monitoring population data, employment trends, vacancy rates, and the overall supply pipeline are the ones who see those shifts coming before they hit. And that's where the real edge comes in. And in this business, edge compounds. If this was helpful, subscribe and stick around. We put this kind of content out regularly for commercial operators, investors who want to build with more clarity and less guesswork.